you went nowhere as a shareholder.
Yeah.
They don't realize this stuff happens. Because at this point, everybody knows you.
Right. They were the new crypto.
And that's really the idea behind DraftKings and FanDuel. The world of online gambling is exploding, Mo. Guys,
Super Bowl told us that.
what?
Commercials.
Oh, yeah.
They were the new crypto.
I was going to say, I hope it doesn't end up like crypto of 2022.
Yeah.
So, guys, I think when I look at this, it feels a lot like the .com era of where every company is just trying to spend whatever it takes to get users. And we have some more data on that with DraftKings. We have a fantasy football game called Dynasty Owner. Dynasty Owner, and this is perfect for our viewer because it's, our viewers are 96% men who love sports. So if you like fantasy football, check it out, dynastyowner.com. But we got killed in the last year trying to get users because everybody said, well, we're getting a ton of money from these casinos that are guaranteed money.
Right.
It sounds a lot like the crypto of like, listen, just pay to get it.
Yep.
It's all about who can grow the fastest in this market. That's always a concern. DraftKings and FanDuel are the biggest ones on the street, right?
Oh, yeah.
Now, DraftKings has been hurt. It hit an all-time high on March 22nd of 2021 at $74.38, according to our software. And it has fallen as low as $9.83, but it's rebounded now to $20.54, a big increase on Friday. Okay? Now, here are some interesting things about DraftKings. You ready? They brought in $1.9 billion in revenue, lost $1.5 billion on that $1.9. Free cash flow last year was a loss of $770. Why? Trying to get users. Gross margin, 33%, not bad. Bottom line, so guys, again, why are you investing? You're investing in this if you really believe that this thing is going to crush it long term.
Right.
But Mo, here's the interesting part for me.
And it's a guess, by the way.
What was that?
And it's a guess.
Correct. $9.2 billion market cap, 10.6 enterprise value. The difference here is essentially the debt. That's not a ton of debt for a company.
No.
But it is a ton of debt for a company that has, well, maybe not. So let's go look at their shares outstanding. Absolutely skyrocketed.
Oof.
So
Wow.
guys, when a company has losses, they can cover those losses in two ways. Issuing debt or issuing equity, which is issuing more shares. The downside to issuing debt is you make the balance sheet worse. The downside to issuing shares is you dilute people. So back in 2019, they had 312 million shares outstanding, and this last reported quarter before the updated numbers, 448 million. That is huge dilution.
The good thing is, if their shareholders don't care, which clearly they don't, then it's fine.
Well, I don't think
that's the great way for them to go.
Right. I think the issue is that they don't realize this stuff happens. Right?
That's exactly right. Yes.
People that we always call the share dilution the silent killer for investing because people don't realize it's happening. So as an example, this is a very important example to explain to people because we're one of the few channels that talks about this. Let's say you have a company that makes $10 a year, okay, and it has 10 shares outstanding. Each share gets $1 of profit. Very simple. 10 divided by 10. Now let's say the company grows and makes $15 a share, $15 total, but they also issue 5 more shares. Guess what?
You went nowhere.
The company went up 50%. You went nowhere as a shareholder.
Yeah.
That is the problem with diluting owners. There's a lot of value investors out there who will look over 10 years, and if there's any shares higher than it was 10 years ago, they avoid the company. Now, I will say this though. Here's the reason why shares going up is okay. If the company's so ridiculously overpriced, I'd rather take on more shareholders as a company saying, listen, why should we issue debt that as the company stock falls, if we borrow $1 billion, if the company stock falls, we still owe that billion. Right. However, if we issue $1 billion in shares at a really high valuation, if the stock falls, doesn't matter to us.
Yeah, we're good.
We don't owe that $1 billion. Right. It's just stock has fallen. And that's also why a good value investor wouldn't want that kind of company because it just shows they're borrowing, they're issuing shares only because the stock is so insanely high. Mo, when we see a company buy shares back, what do we want to see from the company in terms of valuation?
Buying them back at cheaper prices
right.
of the company's stock. We don't want them to be buying when they're trading 100 times earnings or something like that.
Right, because when a company is buying back shares, they're essentially investing in themselves.
Right.
Doesn't matter if it's their shares or not their shares. So when they're buying back their own shares that are 100 times earnings, for example, they're basically investing in a company that's 100 times PE. Is that a good thing? Probably not. All right. Now, when it comes to DraftKings, let's go to the 8 pillars. Not really much to really look at because there isn't 5 years of data. Plus, they have no return on invested capital because they don't make money, blah, 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 blah. This is a company that if you want to buy, you're hoping for this killer number. This killer, hey, this is going to go great. DraftKings is going to kill it, blah, 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 blah.
That's really all it is.
That's all it is. Okay, now one of the things we're going to do different on this channel is for a few companies, as we make their individual videos, we're going to talk about a few data points that support the bear case and the bull case. Now, here's the first bear case that I'm going to give. Their customer acquisition costs have absolutely skyrocketed last year. It's up 23% year over year from 1606 to 1976 per user. So this means they're paying almost $2,000 last year to get a new user. With that in mind, that means that they have an idea of what their user is going to generate them in profit over the lifetime of that user. It better be over $2,000 per user, right? And that's their goal, and it might very well be. But that is the reason why us at Dynasty Owner got hurt, because that big cost to increase to get a user made it hard for us to go get a user for our own game. Mm-hmm. Now, another bear case. The monthly unique players has slowed to about 611,000 people, which still sounds like a lot, but the problem is the monthly users have decreased while the cost to acquire users increase. But that occurs as a company becomes more and more popular, right? So DraftKings and FanDuel, everybody knows them. So in order to get new users to sign up, you got to spend a lot more money. It's not like it's a new game. It's kind of like when you have the start of a company, you kind of look at it like this. Nobody knows about you, so your cost is going to increase. And then as time goes on, it decreases. But as more and more people know about you, you get saturation. It costs more and more money to get an individual user. Because at this point, everybody knows you.
Right.
So to get more and more users, it's going to have to, and you have to spend more and more money to make sure you get the outliers really playing. Right?
Yep.
So when you combine that with less people using, that's a big concern of mine for the company. Big concern. Now, there are some positives. Mo, why don't you talk about some of the bull points of this story?
So online gambling makes up 50% of casino revenue.
That's incredible.
That is absolutely incredible. And DraftKings alone has about 23% of that. So there's 3 or 4 other companies that make up the rest of it. They make up, I mean, this is an oligopoly. It's incredible what they're doing. So second point, revenue per monthly user is up 43% per user.
That's big.
That's a big, big number. So clearly, as they're getting more people, it's working out for them. Now the question becomes, going back to that bear case, is that going to sustain? How difficult is it going to be to get? I mean, everybody knows DraftKings, like you said. And if you're not on DraftKings right now, it's probably because you don't want to be on DraftKings. So how are they going to
And that's the reason
pull you in and say, like, I'm not on DraftKings. I have no interest in this. How are they going to attract me to go and do this?
And that's why the customer acquisition cost is so high.
Exactly.
Because in order to get a guy like Mo to join, he's got to be bombarded.
Yep.
Now, the other benefit, the other bull case for DraftKings, they're investing a lot of money into online stuff. So they don't have the big costs that sports books have, et cetera.
Yep.
So their gross margin of 32.6% should be able to increase as time goes on. Right. And my whole goal would be that as all the players in this market, as this market totally unfolds, the smaller players will probably fall to the wayside and the bigger players will hold. And that's really the idea behind DraftKings and FanDuel. Yeah. Let's just make sure we can control the market. That way, when all the other small side ones go away,
we're the guys.
Yeah. So the question becomes, what are you going to pay for a company like this?
Yeah, this is a tough one.
We have our stock analyzer tool, and our stock analyzer tool is so useful because it allows us to take the future value of we have to estimate the future value of a company based on its future cash flow, right? You present value all the cash flow, and you come up with a price for the company. However, with a company like DraftKings, we have no profit over the last 5 years. We have no cash flow, so everything we do is going to be a guess.
Yeah.
And it's going to take them years before they're cash flow positive. I don't care what they say.
And anything we put in here is assuming that starts today. Profit, let's say we make them profitable, that starts today.
Correct.
Day one.
So I look at it saying, guys, I'd love to be able to do some sort of assessment for this company, but I just can't. If you want to throw a few bucks at this, I'm not going to tell you not to, but for me, I look at it going, it's way too speculative. I'd rather wait for the industry to really throw all the people, all the crap to the side. They have an established business that can generate profit and cash flow. So if you like the software, like what we did here, subscribe to the channel, and we're running a special $7 for 7 days on our software. You can risk $7 to see how awesome the software is, and it'll help change your view on money. Thank you very much for your time.